Today's topic is relevant cost for decision making. In managerial accounting, sometimes managers need to take some decisions whether to buy this product or not to buy this product, right? There may be a number of costs associated in buying or manufacturing. So, which is the right decision? Sometimes it may be very difficult, but for in the managerial accounting, with the help of some techniques and calculating some relevant cost, we are going to evaluate what will be the maximum profit out of whether that you want to manufacture some of the units, or on the other side you are going to buy some product from the other suppliers. So learning objective of today will be understand and apply the relevant costing approach to decision making. Understand decision making in a constrained settings, and understand cost concepts and decision making for joint products. Now, a relevant cost. What is a relevant cost? It is a cost that differs in total between alternatives. There are two alternatives. The total of two alternatives are there. The difference between these two will be the relevant cost. The difference in the cost between two alternatives is known as differential cost, or sometimes we can say incremental cost. To make it more clear, we will understand these costs in the upcoming slides. So identifying the relevant cost. So how we can identify the relevant cost? So cost that can be eliminated in whole or in part by choosing one alternative over another are avoidable cost. It means those costs can be avoided. Those costs can be eliminated. So all those costs which can be eliminated, which can be avoidable cost, those costs are known as relevant cost. Unavoidable costs are never relevant, which include sunk cost. What is sunk cost? Sunk cost, we know that is unavoidable cost. The cost that has already been incurred and that cannot be avoided regardless of what the manager decides to do. The cost which is already incurred, we cannot reverse it. That is known as sunk cost. What is the future cost? Future costs that do not differ between the alternatives is a future cost. Now, look at this question. When deciding whether to buy a new car or a trade in your old an existing car, or just to keep your old car, which of the following are the sunk cost? Option A, B, C, and D. Option A is saying the cost of licensing a new car. Option B, cost of licensing your old car next year if you keep it. The amount you paid for your old car, the C1. The D1 is amount you paid to repair your old car last month in case you wanted to sell it. So from all these four options, there may be one or more answers. Just think over it and let me know the right answer. So which of the following costs are the sunk cost? So in this case, which of the following are a sunk cost? The cost of licensing a new car is relevant, right? It's going to happen next year or next time or when you buy the new car. The cost of licensing of your old car next year, if you keep it, if you're going to keep your old car, what will be the expenditure for that car next year is also relevant, not irrelevant. It's not a sink cost. Amount you paid for your old car, this is already done, right? We cannot reverse it. Amount is already paid. This is the sunk cost, C1. And D also, the amount you paid to repair your old car last month. For example, that you change the filter and oil and you spend couple of dollars. That cost cannot be reversed. This is known as sunk cost. So now we can say C and D is the right answer. When C and D are the sunk cost. Why? Both of these costs have already been incurred, and no decision now or in the future can change that fact. Okay, so next question is in front of you. When deciding whether to buy a new car and trade in your old car or to just keep your old car, which of the following are future costs that don't differ between the alternatives? Don't differ between the alternatives means whether you keep your car, means the old car, or you trade that old with the new one. The two things, two alternatives that we have, right? But whatever that you do, there is no any difference in the cost. What kind of cost that you consider is not going to change, will remain the same in both of the alternatives, means whether you go for one option or whether you going for the another option, it's not going to change. It's not going to make any difference in the cost, right? So there may be more than one answer of this question. You can choose more than one options if you think. Okay, so now in this case, answer A, C, and D. So these three costs you have to be paid. These will be the expenditure for the next year, whether you trade your old car with the new one or you keep your old car. It means monthly parking fees you have to pay. It's not going to make any difference whether it's an old car or a new car. Theater ticket fees, like you go to the theater and buy tickets, not going to make any difference. Driver's license renew fees, maybe $100 or $50, you have to go to ICBC and renew your driving license. So whether that is an old car or it's a new car, it doesn't make any difference. So future cost is known as a future cost. So auto insurance premium usually depend upon the car you drive. If your car is old model, then the value of the car will be differ if you compare with the new one. The premium for the new one, insurance for the new one will be higher as compared to the old one. And also depends on the model. Luxurious car have a more premium as compared to the normal or regular cars. So this is known as the future cost. Now, common mistakes to avoid in a relevant cost analysis. Sometimes we compare some cost and we do some relevant cost analysis, and there may be some mistakes and we can avoid those mistakes. Most cost and benefits do not differ between alternatives. This allows you to focus on new things that do matter. In every decision, you have to examine the data and isolate the relevant cost. Costs that are relevant in one situation are not always relevant in another situation that you keep in your mind. You require different cost for different purposes. This is a basic concept in managerial accounting. Now I'm just going to explain with one example. Let's say a manager at White company want to replace an old machine with a new one, and new one is a more efficient machine. So the new machines and old machine data is available in front of us. So we are going to calculate the relevant cost analysis. The list price for the new machine is $90,000. Annual variable expenses are 80,000 and expected lifetime in a year that is 5 years. Old machines original cost is $72,000. Remaining book value is 60,000. Disposal value is 15,000. And disposal value means when you are going to sell your machine, and the scrap value that you receive some money out of selling off that machine. Annual variable expenses is $100,000. Remaining life in years 5. Now, normally, in this case, some of the cost which is not relevant, as we discussed, the sink cost are not relevant. No doubt, we know that, for example, if in case this company's sales is 200,000 per annum, and fixed expenses other than depreciation are 70,000 per year. So should the manager purchase the new car or not? Just think over it and do some calculation. Think over it and do some calculation, and let me know whether the manager should purchase the new machine or not. So normally what we think and how we think like this, that the manager recommend that the company not purchase the new one machine, since the disposal of the old machine would result in loss. So this is what this analysis is wrong or incorrect analysis, because we know that the book value of the machine is a $60,000, and if we sell that machinery today, and we will receive a $15,000 as a disposal value, and the loss from the selling of this machinery mean disposal, that will be 45,000. On the basis of this small analysis, manager is saying not to buy the new machine. Means if you are going to buy the new machine, it means you have to sell the old one. So by selling it, that manager is saying that we will suffer a loss. So this is the incorrect analysis. The right analysis, that would be totally different. So for the right analysis, so look at this. The correct analysis will be the comparative cost and revenue for the next 5 years. So comparative cost, we are going to compare and make a difference between these two. The first of all, we see that we have a 1 million here, right? So means 200,000 per year is a sale, and we know that this machinery will long last for 5 years. Means the life value of the machine is 5 years. $200,000 sales every year multiply by 5 years is equal to 1 million. This is the sale that we can see if we are going to keep our old machines. And the variable expenditure, if we see the variable expenditure are so $100,000 per year into 5, so that will be $500,000 variable cost. And other expenditure, we have a fixed expenditure. So fixed expenditures are $350,000. So which we can say $70,000 into 5 is equal to $350,000. We know that if we are going to keep our old machine for next 5 years, and definitely we will put some depreciation on that. Whatever the value of this machine today is, that will be depreciated. We will offset the cost of the assets over the period of time. Mean in 5 years, we are going to put $60,000 as depreciation every year. So it means minus 60,000 as expenditure, we will consider it as the depreciation expenditure. Means the remaining book value of the old machines that will be depreciated. Now, if we are going to buy the new machinery, so what will happen? So in this case, 80,000 per year. This is the variable cost for 5 years. It's a $400,000, and we have $350,000. That is the fixed expenditure. It means irrespective of whether we go for any alternative, these expenditure will remain the same. These expenditure may be the rent of the building or maybe the fixed salary for the employees. Now, the $90,000, this is what, this is the total cost that will be depreciated over 5 years period. $90,000, right? So because the new machinery cost is $90,000, then definitely the $90,000 will be deducted here. That will be considered as depreciation for the new machinery after 5 years or during 5-year period. So next we have, if we are going to purchase a new machinery, we know that we have old machinery as well. So old machinery that we are going to sell. When we are going to sell the old machinery, and definitely from our books of accounts, the value should be 0. If we want the value of the old machine should be 0, it means the $60,000 that we will consider as depreciation on the debit side of the profit and loss account, or that will be considered as an expenditure. So $60,000 is the expenditure in this case. And second, we are going to purchase the new machinery and trade in the old one. It means that $15,000 that we will get by selling off the old machinery. So ultimately, that will be added here in this calculation. And we find that $115,000. So that will be our profit if we buy the new machinery. As I mentioned in the first slide, the total of these two, the one alternative and the second alternative, and difference between these two, it means 115,000 minus 90,000 is 25,000. And the same thing we can calculate as the difference cost. This is differential cost. So how we can do that? So 100, let's say 1 million minus 1 million is equal to 0. And $500,000 is a variable expenditure. And here, if we're going to buy it and the variable expenditure are less, it means $100,000 is the expenditure, more expenditure that we will have. Next, it means if we're going to buy this one, it means this more expenditure if we keep it, and then this is the saving if we buy it. So if we are going to buy and purchase a new machinery by replacing the old one, then $100,000 that will be saving for us. And $90,000 definitely that is the expenditure of the company that we will calculate. For the old machinery, is a sunk cost. We are not going to calculate here. It will remain the 0 here. And $15,000 is the disposal of old machinery that we will be having a profit of it. So $15,000 that we will save, 100,000 that we will save, and 90,000 the value of the assets which is depreciated, and the remaining is 25,000 in this way. Either you go for this way or this way, the answer will remain the same. So now, if we talk about relevant cost analysis, then we see that definitely we will go for the new machinery. We'll buy the new machine. So a more efficient way to analyze this decision would be to focus on the cost that differ between the alternatives, means the relevant cost. Now look at this, the relevant cost analysis that we are doing once again, and another way to calculating the same thing. In nutshell, if we say the saving, if we talk about the saving, we know that the variable cost is $100,000 and minus $80,000 is equal to $20,000. It's a variable cost saving if we buy the new machine. So for 5 years, $20,000, that will be the variable cost here. It means that will be saving in the variable expenditure. This is 100. This is a, you can say, if we are going to save some money. So 100,000 that we have saved. Now, if 100,000 we have saved, and plus we will add $15,000 as a disposal value of the old machine, and we will deduct the cost of the new machine. So this is the cost of the new machine, and definitely the cost of the new machine will be considered as a depreciation, because that we will be using that machine for 5 years. And if we don't want to see that book value of the new machinery in our books, it means it will be depreciated over the period of time every year for 5 years. Now, if we talk about the adding or dropping the segments. Now, another scenario, one of the most important decision managers make is whether to add or drop a business segment, such as a product or a store. For example, that you want to drop or you want to add a new product. This is also the most important decision in managerial accounting. So let's see how relevant cost should be used in this decision. Now, due to declining popularity of the digital watches, this is one of the examples that we are taking now. Lowell Company's digital watch line has not reported a profit for several years. An income statement for the last year is shown on the next screen. Now look at this screen and you will find sale is of $500,000. Variable expenditures are $200,000 and $300,000 is the contribution margin. And we have fixed expenditure, which is also calculated here. All these fixed expenditure, the total is $400,000 and net loss is $100,000. Now, managers want to take decision that whether to drop this line or to continue, whether to decline the digital watches as per the information and figures are available in the income statement. So now look at this and just think over it. If you were a manager in the company and you see that this is the statement in front of you, what kind of decision that you will take and what are the figures you will take into consideration for calculating and coming to the point for the decision. One more thing you find by doing some investigation is that once you have investigated in the company, you found that the total fixed general factory overhead and general administrative expenses would not be affected if the digital watches line is dropped. This is very important information. It means there are two expenditures which remain the same over the next years. It's not going to change whether you the drop idea for this article or not. So these expenditures are the total fixed general factory expenditure, so which is also given here. You can find here the general factory overhead is a $60,000. It means that this will remain the same whether you discontinue this product or not. And the second is general administrative expenditure. So these two expenditure are of fixed nature. It's not going to change anymore. The fixed general factory overheads and general administrative expenditures or expenses assigned to this product would be reallocated to other product line. It means if you are going to discontinue this watch productions or discontinue this product in your product line, these expenditure will be considered for the rest of the product line in your same factory. And also one thing you revealed that in the research or investigation that the equipment used to manufacture digital watches has no resale value or any alternative use. It means the machine that was used for manufacturing of the digital watches will have no any value if you sell in the market. No scrap value, no residual value, no resale value, or there is no any alternative use of same machine. Now the question arises, should Lowell retain or drop the digital watch segment? Now, all the decisions will depend upon the manager, how manager will take into consideration all the figures. Now, for your hint, that there is one decision rule. What is that? So decision rule is Lowell should drop the digital watch segment only if its profit would increase. This would only happen if the fixed cost savings is more than the lost contribution margin. It means whatever the fixed cost are allocated for this unit or maybe all the units, if the saving of all those fixed units are more than the loss contribution margin, then that will be profitable to drop the idea or drop the digital watch segment. Now let's look at this solution. Contribution margin loss if digital watches are dropped. So if you are not having, your company is not keeping those products, it means every time there is a sale of $500,000, right? I can show you once again. Look at this. There is a sale of $500,000. If you're going to discontinue this product, you are going to discontinue this product, and it means there will be no sale because you will not be having any product. If there will be no any sale, there will be no any expenditure, and there will be no any contribution margin. So contribution margin is the main factor that we will consider in calculating and making some decisions. So the contribution margin loss that will be $300,000. So look at this now. So contribution margin loss is a 300,000 when the digital watches are dropped, less fixed expenditures or fixed costs that can be avoided. So here we are writing those costs which can be avoided. So it means $90,000 salary to the line manager means this particular line manager, digital watches line manager, advertising cost for this one, and rent of the factory space only for this one. So in this case, these expenditures that we will not pay to anyone. $260,000 that we will not pay, right? So this is the loss minus this is that we will not pay anything, means that the profit. The net disadvantage. So net disadvantage will be $40,000. Now, this is one approach. The second approach we have comparative income approach. So first that we got the contribution. So contribution margin approach. Now the second approach is comparative income approach. The lower solution can also be obtained by preparing the comparative income statement showing the result with and without the digital watch segment. So now look at this second approach, means comparative income approach. So in this case, what is happening? We know that this data is available. We need to keep the watch, and in second is the drop the watch. So we are going to make a comparison between these two. The first that we have the $500,000, the sales that is going minus in the bracket mean minus. We are not having that money. We will not receive this money. Less variable expenditure that we will save. We will save it. So that will be the positive, all these three. And the total variable expenditure this much, and we will deduct it. So $300,000, that will be the contribution loss in this case. So if we have the contribution loss in this case, now we are going to calculate the next figure. So it means the $300,000 that is we are losing. The company gives up its contribution margin here. On the other hand, the general factory overhead would be the same. It's not going to change. So this cost really is not relevant. It means the $60,000 here is expenditure if we keep the digital watch, and if we drop the digital watch line, then the fixed cost general factory overhead is not going to change, nothing. $60,000, right? So it means but we won't need to manager for the product line anymore. If we are going to drop this, it means that $90,000 we will not pay for the manager. It's a future cost. Depreciation, future cost we are going to consider. And also that we are not going to consider the depreciation, like $50,000 depreciation. We are not going to consider the depreciation here, right? So for the calculation purpose, we are not going to consider it. Next, we have the $70,000. So $70,000 is the rent. Rent means factory space. So $70,000 that is the future expenditure. We will have to pay, no any alternative. And general administration expenditures that will remain the same, like fixed expenditure. So 30,000 plus 60,000 plus 50,000, that is not going to affect anything. It's a sunk cost. So this is the future cost, $90,000 that we saved, $100,000 we saved. $70,000 for the rent of the factory space is saved. So $40,000 again, that we can say the net cost with the help of comparative income approach. And the last time that we compared with the another approach, contribution margin approach. Now, so next is beware of allocated fixed cost. Why should a company keep a business segment when it is showing a loss? Now, this question comes in our mind. That definitely there is a loss. Definitely there is a loss of $40,000. So why our organization, our business will keep this line, this business segment when it is showing a loss? The answer lies in the way common fixed costs are allocated to the product line, as allocation can make the segment look less profitable than it really is. So it means a common cost, the common fixed expenditure, supports the operation of more than one segment of an organization and is not avoidable. We cannot avoid it in whole or in party by eliminating any one segment. It means if we are going to drop one segment or discontinue one segment, but these costs we have to bear. We cannot ignore it. So that's why that we need to take decisions to keep the product. To make or buy decision. So next is to make or buy, means to manufacture or to buy from other suppliers. Sometimes these decisions are also important in managerial accounting. A decision concerning whether an item should be produced internally or purchased from an outside supplier is called make or buy decision. So now let's have a look at the Essex company example. So this example shows that Essex manufactures part 4A that is currently used in one of its product. Some parts they are going to manufacture, but those parts they use in making one big unit in one of its product. The cost per unit of this part is given. So the cost of this unit is direct material, direct labor, variable overhead is 1, depreciation of a special equipment 3, supervisor salary 2, and general factory overheads 10. So total cost per unit is available, that is $30 is the total cost per unit. Now the special equipment used to manufacture part 4A has no resale value or a residual value. This is the information given. So next information is the total amount of general factory overhead, which is allocated on the basis of direct labor hours, would be unaffected by this decision. It means direct labor hours will remain the same, right? Irrespective of the decision whether to buy or make. $30 total cost per unit is based upon the 20,000 parts produced every year. So this is one more information available, like 20,000 parts mean units produced every year with a cost of $30 each. An outside supplier has offered to provide the 20,000 parts at the cost of 25 per part. So it means one offer they have received from the supplier. Now question arises, should we accept the supplier's offer or not? This is the question. Now, in this case, what you can do, you can write down some of the important information on the paper, just like is shown here. So what are the important information? Go back, I can show you. So first of all, write all this information and the total cost per unit, which is differentiated in this way: direct material, labor, variable overheads, depreciation, and supervisor's salary, general factory overheads. All these costs per unit you need to write on the paper, and total is 30. Take a screenshot or you can write on the paper. And the next information you have that $30 total cost per unit is based upon the 20,000 parts produced every year. Means in 1 year, 20,000 units will be produced. But what is happening? The other suppliers come and have given one offer. They are saying, so this is the total cost that you have for this product, and I'm just ready to give you same kind of products at the rate of $25 per unit or per part. So the question arises in the mind of the manager, should we accept the supplier's offer or not? This is the main question. Now, in this case, what we can do, we can make a two line. The one will be in the heading, we will write make, and another buy. To make, what is the cost, what are the expenditure, and to buy, what are the expenditures. We know if you want to buy, the expenditure will be just $500,000, right? Because 20,000 into 25, that will be $500,000 if our company is going to buy the same product from outside the suppliers. So look at this. And we know that the direct material, direct labor, variable overhead, depreciation, supervisor salary, general factory overheads, that will be 30. So if we calculate everything, 1, 2, 3, 4 points here. The first one is 180,000, 20,000 into 9 per unit. This is the $180,000. It's the direct material. Definitely we will have to spend it. Material is required. And second, the next we have the special equipment has no resale value. So if it does not have any resale value, means so the special equipment has no resale value, is a sunk cost. So sunk cost, that we are not going to write it. Next we have not avoidable. We cannot avoid. Not avoidable and is irrelevant. If the product is dropped, it will be reallocated to the other product. It means like general factory overhead, as it was mentioned in the note, that general factory overhead, which is allocated on the basis of direct labor hours, would be unaffected by this decision. So general factory overheads, that is not going to make any difference. So this general factory overheads, that we are not going to consider here, and we are not making in the total, right? So depreciation of the equipment that we are not considering, and this is also that we are not considering. Now, should we make or buy the part 4A, right? So this is that what we have done. So in this case, we have calculated that $340,000. If we're going to make it, the cost will be less because we have calculated number one, variable cost, second, variable cost, third, variable cost, direct material, direct labor, and variable cost, and supervisor salary 40,000. So in this case, definitely we will make the product instead of buying. That will be more economical. So we will save a couple of dollars. Now, the simple thing is that the make or buy decision, the decision rules will be in deciding whether to accept the outside supplier's offer. ESACs isolated the relevant cost of making the part by eliminating the sunk cost, right, which has not any relevance. Only the relevant cost has been taken, and future cost that will not differ between making or buying the part. So these two things that we need to consider. So in the previous, you can see direct material, definitely we are going to make, it will be added. Direct labor will be added. Variable overhead will be added. Depreciation is not going to add. So depreciation is like fixed expenditure. It's not going to add anything, right? Then supervisor salary we will pay. Right? General factory overhead, it was already mentioned that the general overhead and factory overheads. So these general factory overheads that will be unaffected by the decision. This information is also given. So this is the rule. Now, next point is opportunity cost. What is the opportunity cost? The benefit that are foregone as the result of pursuing some course of action is known as opportunity cost. So opportunity costs are not actual dollar outlay and are not recorded in the accounts for an organization. For example, so opportunity cost are not actual dollar outlay. It doesn't mean that if that cost is in the dollar value or not. It may be in the dollar value or it may not be the dollar value, but that is also opportunity cost. Now, one example is in front of you is that which of the following are opportunity cost of attending the university? For example, that you are going to the university and you are attending the university, you are going in the class, like you, all of you are studying in the college, right? So what is the opportunity cost for you? So which of the following are the opportunity cost of attending the university? Means you are sacrificing something for attending the college, for going to the college. What is the right answer according to you?